Have you wondered how millionaires or billionaires are able to grow their money consistently over their lifetime? Do you want to learn some of the important approach towards dealing with the personal finance? Also, let's understand what is 50-30-20 rule. We will cover most of the details in this video and watch till the end to improve your personal finance skills. Hi everyone, welcome to FinBites. Before starting this video, I want to wish all of our YouTube family members a very happy and prosperous Ugadi and Gudi Padwa. On this happy note, let's get into today's video and implement something new this year. When we look into the most common habits what the billionaires have is that they understand how money works in this world. They all possess a solid financial knowledge. Because of good financial knowledge, they understand the trick of growing their money by investing. But many common people don't even prepare a basic financial plan and avoid completely when it comes to finance. The reasons for this would be, we think finance is complicated, or not much knowledge was shared with us during our school days. So today, we will be creating a simple financial plan using a simple financial rule. The rule we will be looking through is 50-30-20% rule. The rule is very simple and it states that 50% of our money we earn monthly should be used for our daily needs. 30% should be used for our lifestyle expenses and minimum of 20% should be used for investing. Let's check out with an example. We can always translate this rule with our real earnings accordingly. Imagine a person's monthly salary is 50,000 rupees. 50% of the earnings is 25,000 rupees. It is used for the purpose of daily needs such as food, shelter and other basic necessities. 30% is rupees 15,000. This 15,000 can be used for the purpose of monthly entertainment, clothing, hotels, traveling, etc. The 20% part turns out to be rupees 10,000, which is very important. This 10,000 is used for the purpose of investing. This money compounds over a period of time which eventually makes us wealthier. The whole crux of this rule is, come what may, one has to invest at least 20% of his earnings. We may think by investing just rupees 10,000 every month, what big difference one can achieve. Rupees 10,000 monthly saving will turn out to be 1.2 lakh of principal amount in 1 year. By investing only rupees 10,000 monthly for around 25 to 30 years gives us a huge corpus between 7 to 10 crores. Along with this, our salary won't be constant throughout the lifetime. It will be increasing, and accordingly, if we invest 20% in a disciplined manner, our corpus accumulated will also compound more aggressively. By investing just 10,000 rupees, we can achieve such a huge corpus, and if we try to invest up to 50% of our earnings, then our compounding will become more aggressive and we can build huge corpus in shorter duration. I know 50% savings is quite ambitious target, but this is also possible if we have a good financial plan. At this point, you might have a question of how to multiply our money. Can we invest in stocks, mutual funds, bonds, FDs or RDs? To answer this question, we will look into another quick rule. This rule is 100 minus our age rule. For example, let's take a person's age is 30 now. When we subtract 100 minus 30, it is 70. This 70 states that 70% of the investing money can be put into high volatile asset classes such as equity mutual funds or cryptos. Remaining 30% of the investing money can be put into low volatile asset classes such as bonds, gold, FD or RD. Let's consider another example. If your age is 55, 100 minus 55 is equal to 45. So 45% of our money should be invested in high volatile assets and remaining 55% of our money should be invested in low volatile assets. As and when we get older, the requirement of liquid cash is more needed as our expenses will be increasing. This is the exact reason why we see lesser allocation into high volatile asset classes when we grow older. Again, this rule is applicable for people who are new to investing world. Based on our psychology, experience, net worth, the asset allocations will be changing time to time and person to person. So, 100 minus age rule is always a good point to start with. Now, let's have a quick look on various investing avenues which we discussed above. Number 1. Stocks or direct equity. Many people have no knowledge or little knowledge about stock markets in India. It is the digital technology which is encouraging more people to enter into stock markets, which is a good move. But always be careful, and one should understand the risks before investing into any asset classes. Do not enter into an investment blindly just because other people are doing. Understand and analyze your own risk profile and then take your own investment decision. To understand and learn about basics of stock markets, you can check out my Basics of Stock Market playlist, where I'll be explaining about each and every topic what a beginner should learn in his investment journey. In simple terms, stocks are nothing but you becoming a part owner of a particular company. Company usually need funds to grow their company, and one way to raise funds by giving out shares to public or big investors and in return collect money from them, which is usually used for the purpose of company's growth. Number 2. Equity mutual funds. If you don't have much knowledge on analyzing businesses, then you can hire a fund manager who will do all the research and buy shares on behalf of you. He pools money from like-minded individuals and invests into various companies. The returns earned are passed on to its investors after charging a small nominal fee. There are many concepts, schemes and strategies which are to be understood in mutual funds as well. You can check out my mutual fund playlist to understand basic concepts, how to evaluate our mutual fund portfolios, etc. Number 3. Cryptos. It is a very high volatile asset class, and I would say beginners should avoid entering this asset class. But if you want me to cover about this topic, do comment below. I will make a dedicated video on cryptos if there are more interest. Number 4. Bonds. If a company promoters doesn't want to give up their ownership but still wants to raise money, they can do it using debt markets. In simple terms, bonds are debt instruments where companies borrow money from public or big investors and in return give them a predetermined interest amount until maturity. At the maturity, the investor's principal amount will be returned back to the investors. Again, one can invest in bonds through mutual funds, or one can directly buy bonds through companies. Number 5. Gold. Most of Indians are well versed in gold. A small point to be added is, if you are purchasing gold from an investing point of view, always consider subscribing to sovereign gold bonds, SGBs. This gives us an additional 2.5% yield yearly, and if held for more than 5 years, we need not pay any long-term capital gains tax. SGBs has no issues such as theft, wastage or making charges, purity issues, etc. With this, I guess I have briefed about some of the important asset classes for investing. If you want me to cover any particular asset class in detail, do comment below. If there is enough interest, I will make a dedicated video on it. If you have learned something new today, hit the like button, as this will help the video to reach more people. If you are visiting our channel for the first time, subscribe to our channel and press the all notification bell button so that you will receive notifications from YouTube when we post new videos. Once again, Happy Ugadi and Gudi Padwa for all our YouTube family members. Have a great weekend. Thank you. Bye.